Stop what you're doing. Close every other tab. Turn off the distractions. Because what I'm about to tell you isn't theory. It isn't speculation. It's happening right now 2,000 miles south of the U.S. border in the mountains of Zacatecas, Sonora, Chihuahua, and Durango. And it's about to send shockwaves through every financial market that depends on silver. Mexico, the world's #1 silver producer, the nation that supplies 23% of global silver output, over 200 million ounces annually, is teetering on the edge of a supply blackout. Not gradually, not in some distant future. By the second quarter of 2026, just months from now, the system could snap. You need to understand 3 converging forces that are about to collide. First, organized criminal cartels have escalated from simple extortion into direct operational involvement in mining regions. They're not just asking for payments anymore. They're controlling logistics, targeting shipments, and infiltrating operations. Second, Mexico's powerful mining unions are staging coordinated strikes and work stoppages across multiple states simultaneously, demanding profit sharing that companies claim they cannot afford while operating under elevated security costs and regulatory pressures. Third, President Claudia Sheinbaum's administration has declared that no new mining concessions will be granted, signaling the most aggressive resource nationalism policy Mexico has implemented since the 1938 oil nationalization. 3 forces, 1 outcome. Mexico's silver production, the lifeblood of global solar panel manufacturing, electric vehicle production, electronics, medical devices, and defense systems, is about to face a disruption unlike anything the market has priced in. Let me show you exactly what's happening in the mountains, where 6,300 metric tons of silver were produced in 2024. Let me show you why the companies that spent decades building these operations are quietly preparing contingency plans. And let me show you why the price you're seeing on your screen right now, trading between $90 and $95 per ounce, still doesn't fully reflect the reality developing on the ground. Because when the world's largest silver producer faces systematic disruption, the shortage doesn't announce itself with headlines. It moves through supply chains silently. Delivery delays extend from weeks to months. Premiums explode from a few dollars over spot to tens of dollars over spot. And by the time the mainstream financial media figures out what happened, the metal is already allocated and the price has repriced to a level that strains industrial margins and forces manufacturers into bidding wars they cannot win. This is the story of Mexico's silver revolt, the convergence of criminal pressure, labor uprising, and government resource nationalism. The perfect storm that Wall Street isn't fully pricing in and Washington doesn't completely understand. And the timeline suggests we're entering the critical period in the months ahead. Let's start with the geography, because you cannot understand the crisis without understanding where Mexico's silver actually comes from. This isn't spread evenly across the country. It's concentrated in a handful of states that produce the overwhelming majority of the nation's output. Zacatecas accounts for approximately 40% of Mexico's total silver production. The Fresnillo mine, operated by the company of the same name, is the world's largest primary silver mine. Then you have the Peñasquito mine, owned by Newmont, which combines gold, silver, lead, and zinc extraction. These 2 operations alone represent a massive percentage of global silver supply. Zacatecas is also where some of the most significant security challenges have been reported over the last decade. Sonora is home to multiple large-scale operations, including the Herradura mine and operations near Cananea. Sonora's copper-silver operations are critical because silver comes out as a byproduct of copper mining. When copper operations slow down or face disruptions, silver production is affected too. Chihuahua contains several mid-sized silver operations, including First Majestic's Santa Elena mine. The state sits on the U.S. border, which makes it strategically critical for export logistics. Disruptions here don't just affect production, they affect the ability to get refined silver into U.S. markets. Durango rounds out the big 4. Smaller operations, but critically important to total national output. Durango has seen increasing security concerns over the last 3 years, with reports of extortion schemes targeting both large, multinational operations and smaller domestic producers. These 4 states represent over 80% of Mexico's silver production. They're also the epicenter of the challenges we're about to discuss. And those challenges have 3 layers. Layer 1 is organized crime pressure, and this represents a significant evolution in how criminal organizations operate in mining regions. For years, cartels focused primarily on narcotics trafficking, cocaine, methamphetamine, fentanyl moving north into the United States. Mining was ancillary. They'd extort payments from companies, occasionally steal ore, but it wasn't core business. That appears to have changed significantly over the last decade. Starting around 2015, according to security analysts and media reports, cartels recognized something critical. Mining generates billions in revenue. It's legal. It involves complex logistics chains that can be infiltrated. And most importantly, foreign mining companies are vulnerable targets. They can't fight back with force. They can't easily relocate. They need to operate continuously to justify the billions in sunk capital. The Knights Templar cartel in Michoacan pioneered an aggressive model with iron ore operations. According to investigative reports, they didn't just extort operations, they attempted to control them. They ran mines. They negotiated sales directly with Chinese buyers. They used mining revenues to fund cartel operations, while simultaneously laundering drug proceeds through mineral shipments. Other cartels reportedly observed and adapted. The Jalisco New Generation Cartel, the CJNG, one of Mexico's most powerful organizations, began expanding into Zacatecas. The Sinaloa cartel factions, fighting each other in Sonora, reportedly recognized that copper and silver operations generated more stable revenue than drug shipments that face interdiction at the border. By the early 2020s, the pattern became increasingly documented. According to reports from mining companies, security consultants, and investigative journalists, cartels had moved from simple extortion toward more sophisticated operational interference across multiple Mexican states. Let me give you specific documented examples. Pan American Silver suspended operations at its mine in Zacatecas in October 2023 due to what the company described as theft of silver concentrate. This wasn't a simple robbery. The company stated that security conditions made continued operations untenable. They shut down. Americas Gold and Silver announced in early 2023 that its Cozalá mine in Sinaloa was affected by what they termed prolonged blockades. The mine couldn't function normally. Workers faced access issues. Ore transport was disrupted. The operation went offline. In Guerrero, one of Mexico's states, facing significant security challenges, reports emerged that mining companies were paying what some called protection fees to organized groups. This was publicly acknowledged to exist as a broader problem by former President López Obrador, though he didn't specify individual companies. The mechanics of this criminal pressure, according to security experts, are sophisticated and multi-layered. Criminal groups don't just show up with overt threats. They've studied the supply chain. They understand where the vulnerabilities are. First, they target transportation. Mexico's mining operations depend on truck transport to move ore from mines to processing facilities, and then to ports or border crossings for export. Criminal organizations reportedly control segments of highways in certain regions. They set up checkpoints. Companies that refuse demands face the risk of vehicle hijackings, driver threats, or worse. One security consultant who worked with mining companies told media that, in some areas, criminal groups were reportedly charging fees based on tonnage extracted. For a large operation producing thousands of tons per day, according to these estimates, that could represent hundreds of thousands of dollars per month flowing to organized crime. Second, they attempt to infiltrate the workforce. According to security assessments, cartels recruit or coerce mine employees, drivers, security personnel, even administrative staff. This provides inside information on shipment schedules, production volumes, and security measures. When a valuable concentrate shipment is ready to move, criminal networks may have advanced knowledge. Third, they target executives and their families. Kidnapping for ransom remains a documented threat in certain Mexican states. But the more insidious version is intimidation. Reports indicate that cartel representatives approach company executives with information designed to demonstrate surveillance. We know where your children attend school. We know your family's routines. Cooperation is expected. Most executives, understandably, comply or seek to relocate their families. Fourth, they exploit weak local governance. In regions where the rule of law has been compromised, police, municipal officials, and even some judicial authorities are either compromised or too under-resourced to act effectively. When mining companies report extortion or theft, investigations often go nowhere. Arrests are rare. Convictions are nearly non-existent. The result is an environment where major multinational mining companies, corporations with billions in market capitalization and professional security operations, struggle to protect their assets. They're forced to choose between operating under these conditions, investing heavily in private security, or considering exit strategies. And according to industry observers, criminal organizations aren't satisfied with just extracting payments. Reports suggest movement toward more direct involvement in dictating operational terms, which buyers to sell to, what prices to accept, how much production to allocate to legal channels versus potential black market sales to buyers willing to pay cash for untraceable silver. This is the first force destabilizing Mexico's silver production. Criminal organizations that view mining as potentially more profitable and sustainable than narcotics in certain regions. And despite the Mexican government deploying armed police units to protect mines in some areas, providing security across such geographically dispersed operations remains an enormous challenge. Layer 2 is labor unrest. And this is where the timeline becomes particularly relevant because the labor situation in Mexico's mining sector has been building pressure throughout 2025 and into early 2026. Mexico's mining unions have historically been powerful, but under the current political environment, they've become increasingly assertive. The National Union of Mining, Metallurgical, Iron, Steel, and Similar Workers, led by Napoleon Gomez Urrutia, represents hundreds of thousands of workers across Mexico's extractive industries. Gomez Urrutia is not just a union leader, he's a senator for the ruling Morena Party. He has direct access to President Sheinbaum's administration, and he's made it clear publicly that he intends to use that political influence to extract maximum concessions from mining companies. The core issue is profit sharing. Under Mexican law, companies are required to distribute 10% of profits to workers. But a 2021 reform capped these payments at the greater of a 3-year trailing average, or 3 months' worth of salary. Mining unions have argued this is insufficient, given the elevated profits companies generate with silver prices, now trading above 90 per ounce. The mathematics create tension. Companies operating in Mexico face higher security costs due to criminal extortion pressures. They face increased regulatory compliance costs due to new environmental and community approval requirements. They face uncertainty about whether their concessions will be renewed. And they face demands for profit sharing that, if granted at the levels unions seek, would significantly compress operating margins. So conflicts escalate into strikes. The most dramatic example is what became known as the longest labor dispute in Mexican mining history. The Cananea copper mine strike lasted 18 years. 18 years. Workers walked off the job in 2007 and didn't return until December 2025. The resolution involved $26.8 million in compensation, funded not by the company, Grupo Mexico, but by the Mexican government through a specially created fund. This precedent concerns mining companies significantly. It suggests that the government may intervene to fund strike settlements, potentially removing incentives for unions to negotiate directly with employers on economically sustainable terms. It also demonstrates that strikes can last not months, not years, but decades, with workers receiving government or union support to sustain the action. Other mines have followed similar patterns. In August 2024, Industria Españoles announced that its Tazapa mine halted operations indefinitely due to a strike called by the National Mining Union. The union claimed violations of the collective labor agreement. The company stated it was in full compliance. The dispute continued. In April 2025, labor disputes affected operations at multiple mines across Sonora. President Sheinbaum's administration allocated $2.7 million to establish a task force to mediate disputes. But the mediation process moves slowly. Mines sit idle. Silver production stops. And here's the critical observation. These strikes appear to be becoming more coordinated rather than isolated incidents. Union leadership appears to be timing actions to maximize pressure on companies. When one mine settles, another may launch a strike. Industry observers suggest the goal is to create continuous disruption that forces companies into agreements that fundamentally alter the economics of Mexican mining. First, Majestic Silver reported record production in 2025, reaching 15.4 million ounces of silver for the full year. But the company's operations in Mexico operate under constant labor pressure. Any one of their 4 Mexican mines could potentially face a strike, and once a strike begins, there's limited certainty about resolution timelines. America's gold and silver achieved record 2025 silver production of 2.65 million ounces, driven by strong performance at Cozalá after resolving the prolonged blockade. But Cozalá remains potentially vulnerable. The underlying tensions that led to the blockade haven't necessarily disappeared. They've simply been temporarily resolved. The pattern is clear. Mexican mining operations face a labor environment where strikes can be launched with relatively short notice, can persist for extended periods, and increasingly receive support from a government that views resource nationalism and worker empowerment as core political priorities. This brings us to the third force, government policy. And this is where the long-term structural shift becomes unmistakable because the Sheinbaum administration is not hiding its direction. They're stating it publicly, clearly, and repeatedly. On June 23, 2025, President Claudia Sheinbaum declared there will be no new mining concessions. No new mining concessions. She repeated the word no twice for emphasis. This wasn't an offhand comment. This was stated policy. The moratorium on new mining concessions continues the stance initiated by former President López Obrador starting in 2019. But Sheinbaum has reinforced and expanded this approach. She's framing mining policy not primarily as economic development, but as environmental protection and resource sovereignty. Silver, copper, and other strategic minerals are increasingly treated as national patrimony that must be managed with state oversight. Secretary of Economy Marcelo Ebrard confirmed this direction stating that the mining industry is at the core of Mexico's economic security decision-making. This language is significant. When a government frames an industry as a matter of national security, it's signaling that commercial considerations may be subordinate to political and strategic objectives. Mexico's approach aligns with a broader wave of resource nationalism that has been sweeping Latin America. Chile has moved toward lithium state control. Bolivia has long maintained state management of its lithium reserves. Argentina, under populist leadership, has signaled increased state oversight of minerals. Mexico is following this regional pattern, but focusing on silver and copper. The fourth transformation, La Cuarta Transformación, is the ideological framework driving these policies. Morena, the ruling party, explicitly compares their agenda to three previous transformations in Mexican history: independence from Spain in 1810, the liberal reform that established a secular republic in the 1850s, and the Mexican Revolution that instituted national control over subsoil resources in the early 1900s. This isn't just political rhetoric, it's a declaration of historical mission. Mexico nationalized oil in 1938 under President Lázaro Cárdenas. The Morena administration signals they view themselves as continuing that tradition of asserting Mexican sovereignty over natural resources. Now, to be absolutely clear, outright nationalization of silver mines hasn't occurred yet. The government hasn't seized foreign-owned operations, but they've created what industry analysts describe as an increasingly challenging environment for private investment. No new concessions means no new projects. Existing operations face regulatory scrutiny, labor pressures, and security challenges. The economic incentive to make new long-term investments in Mexican mining has diminished significantly. And observers note the government appears aware of this dynamic. They're watching as foreign companies struggle with the operating environment. Some analysts suggest the government may be waiting for companies to exit voluntarily or sell operations at distressed valuations. At that point, Mexican state-owned entities or domestic companies with government backing could potentially step in and acquire operations. The precedent has already been established in other sectors. Mexico nationalized lithium in 2022, creating a state company called Litio MX. The electricity sector has seen increased state control. A rock quarry was seized in 2024. Each action reinforces the pattern. Private foreign ownership is being systematically reduced while state influence expands. For silver, the implications are profound. Mexico produces 6,300 metric tons annually. That's over 200 million ounces. If even a significant portion of that production goes offline due to strikes, criminal disruptions, or regulatory delays, global markets face a supply deficit that cannot easily be filled from other sources. Peru, the second largest silver producer, generates about 108 million ounces annually. China produces roughly 109 million ounces, but most of that is consumed domestically. Bolivia, Chile, and Argentina combined produce approximately 115 million ounces. Even if every other producing nation attempted to increase output, they couldn't immediately replace Mexico's contribution. And they're not increasing output rapidly. They're facing their own challenges. Labor disputes in Peru, environmental opposition and regulatory complexity in Chile, economic instability in Argentina, political opposition to new mining projects in multiple jurisdictions. The global silver supply chain depends fundamentally on Mexico continuing to produce normally. And Mexico is not operating under normal conditions. It's navigating a convergence of pressures that could intensify in the second quarter of 2026. Let me show you the timeline. Let me show you why the next several months represent a critical period. January 2026, we're here now. Mines are operating, but under significant pressure. Criminal extortion continues to be reported. Labor tensions remain elevated. The Sheinbaum administration is working to finalize regulations for the reformed mining law. These regulations, which have been delayed since November 2023, will determine operating parameters for existing concessions. February 2026. The government has indicated plans to address the backlog of pending permits and regulatory approvals. By February or March, there should be greater clarity on which operations receive necessary approvals and which face potential denial or delay. Any significant negative decisions will signal that the government is tightening oversight even further. March 2026. Silver prices are at historically elevated levels. Spot prices between $90 and $95 per ounce as of late January 2026. This creates increased pressure on profit-sharing negotiations. Unions will likely push for larger payouts based on these elevated revenues. Companies will resist, citing increased costs and regulatory uncertainty. The gap between union demands and company offers may widen. April 2026. Spring is typically when labor agreements are renegotiated in Mexico across various industries. Multiple mining unions will likely be in active negotiations simultaneously. If even 2 or 3 major operations face strikes during peak negotiation season, production could drop measurably. May 2026. If strikes launched in April are not resolved quickly, inventory drawdowns would begin to accelerate. Refineries that depend on Mexican concentrate would start managing allocations more carefully. Dealers might report extending delivery timelines. Premiums over spot prices could begin widening beyond normal ranges. June 2026. If disruptions have not stabilized by June, markets could face measurable tightness. COMEX registered silver inventories, sitting around 113 million ounces currently, could potentially drop toward critical thresholds if supply disruptions coincide with continued strong demand. Physical silver sourcing could become more challenging. This timeline isn't a guaranteed prediction. It's a risk assessment based on observable patterns and historical precedent. The factors driving toward potential disruption appear to be building rather than dissipating. Now let me show you who potentially benefits and who faces risk, because this isn't just an academic discussion about supply chains. This represents a potential wealth transfer event. Significant capital will move from those unprepared for supply disruption to those who positioned before it became obvious. The entities facing the most risk are clear. Companies heavily invested in Mexican mining operations face operational uncertainty. Their capital is deployed in assets that could face shutdown at various points due to strikes, security incidents, or regulatory challenges. If nationalization eventually occurs, compensation might not reflect full market value. It would likely reflect a government-determined price based on political considerations, rather than commercial valuations. Industrial users of silver face the prospect of significant cost increases. Solar panel manufacturers, electric vehicle producers, electronics companies, medical device manufacturers, they all depend on stable silver supply at predictable prices. When Mexico's production faces disruption, they're forced into more competitive procurement. Smaller manufacturers may be priced out of certain markets entirely. Larger ones would see margins compressed significantly. Investors holding paper, silver representations, ETFs, unallocated accounts, futures contracts, may discover that physical delivery becomes problematic during genuine shortages. When supply tightens significantly, the spread between paper price and physical price can widen dramatically. Your ETF might show $95 per ounce, but physical coins might trade at $130 or more. The paper representation loses effectiveness when conversion to physical metal becomes difficult. Now the potential beneficiaries. Physical silver holders. Anyone who owns silver in their direct possession, coins, bars, stored outside the financial system, would see their purchasing power potentially multiply during a genuine shortage, not through speculation, but by holding an asset that becomes difficult to source elsewhere. Silver mining companies operating outside Mexico, Canadian operations, U.S. mines, Australian producers. Their product becomes valued at significant premiums because they can deliver when Mexican operations cannot. Their stock valuations would likely surge as investors desperately seek exposure to non-Mexican supply sources. China. China has been systematically positioning for resource security. They've been contracting Mexican silver production through direct purchase agreements. They've been building strategic stockpiles. If Mexico's exports to Western markets face disruption, China would control a disproportionate share of available supply. They would leverage that position in negotiations over trade, technology transfer, and geopolitical matters. Sophisticated traders who recognize supply vulnerability early, anyone who understands that supply may contract while demand remains stable or increases, could position accordingly, buying physical now while premiums are $8 to $15 over spot. When genuine shortages manifest and premiums potentially reach $40 to $50 over spot, the strategy shifts from buying to strategic selling to desperate industrial users who need metal to maintain operations. So what does this mean practically? How should informed observers think about positioning for potential supply disruption? First, understand the fundamental difference between price and availability. Silver might be quoted at $93 on the COMEX, but if you cannot take physical delivery for several months, that quoted price has limited practical meaning. Availability becomes what matters. Securing physical silver now, while delivery timelines remain relatively normal, represents insurance against future tightness. Second, analyze exposure to Mexican operational risk, if holding mining equities. Review your portfolio carefully. Any company with substantial operations concentrated in Mexico faces elevated structural risk. Consider rotating toward companies operating in more stable jurisdictions, with lower political and security risk profiles. Third, monitor leading indicators closely. COMEX registered silver inventory levels. If they drop below 80 million ounces, the system enters more fragile territory. Watch delivery delays reported by major dealers. If standard products shift from 1-week shipping to 6-week shipping, tightness is materializing. Monitor the premium spread between physical and paper. If retail silver sells for $25 over spot when it's normally $10 over, the disconnect is accelerating. Fourth, prepare for volatility. When supply squeezes develop, price movements become violent and unpredictable. Silver could spike $15 in a day, then decline $12 the next day, then surge $25 the following week. This isn't a smooth trajectory higher. It's chaotic price discovery, position in ways that allow weathering these swings without being forced to liquidate at unfavorable moments. Fifth, think through the eventual resolution. Mexico's silver production won't remain disrupted indefinitely. Eventually, either conditions stabilize enough for operations to normalize, or the government moves toward greater state control and manages production through different structures. When supply eventually returns to markets, prices will adjust. Extreme premiums will fade. The strategic objective is recognizing when to take profits during the shortage, rather than holding through the full cycle. Let me connect this to the broader global context. Because Mexico's silver challenges aren't occurring in isolation. They're part of a worldwide realignment where resource-rich nations are increasingly asserting control over strategic commodities. We've observed China implement export controls on rare earth elements, gallium, germanium. We've seen Russia restrict fertilizer and metals exports. We've watched Indonesia ban nickel ore exports to force domestic processing. We've seen Chile move decisively toward lithium state management. Every resource-rich nation is observing these patterns and considering similar strategies. The era of unrestricted market-priced access to raw materials is shifting. The era of resource nationalism, strategic stockpiling, and supply chain weaponization is emerging. Mexico's silver is one high-profile example of a pattern that is repeating across multiple commodities and jurisdictions globally. For investors and industrial users, this means fundamental assumptions must be reconsidered. You cannot assume that supply chains will remain open simply because they've been reliable for decades. You cannot assume that prices will stay anchored to historical ranges when governments treat commodities as strategic assets. You cannot assume that governments will always prioritize foreign investors over domestic political constituencies. The primary protection is owning physical assets directly, physical metal, stored outside the financial system, not dependent on any counterparty, any government promise, any bank, any exchange. Mexico is the world's #1 silver producer. They supply 23% of global output, and they're navigating toward potential production challenges driven by criminal pressure, labor militancy, and government resource nationalism. The convergence appears to be building toward a critical period in the second quarter of 2026. The sophisticated institutional money is already adjusting positions. They're increasing physical allocations. They're reducing exposure to Mexican mining operations. They're preparing for a supply environment that could create sustained tightness lasting not weeks or months, but potentially quarters or longer if Mexico follows through on aggressive resource nationalism. You have a choice. Dismiss the warning signs because they haven't yet dominated financial media headlines, or recognize that the system is showing measurable stress in real time, 2,000 miles south of the border, in mountains most investors will never visit, where decisions are being made that will reshape global silver markets for years. The Cananea strike lasted 18 years. That resolution happened just over 1 month ago, in December 2025. If current labor disputes follow similar duration patterns, Mexican silver production could face extended disruption measured in years rather than months. And the criminal organizations are not retreating from mining regions. They have recognized that mineral extraction offers revenue streams that are more stable and face less interdiction risk than traditional narcotics trafficking. They're unlikely to voluntarily abandon those revenue sources. The government is not reversing course on resource nationalism. President Sheinbaum has staked significant political capital on the fourth transformation ideology. Backing away from resource sovereignty messaging would represent political retreat that appears unlikely given the administration's strong mandate. 3 forces: criminal pressure, labor assertion, government nationalism, all converging, all building, all pointing toward heightened risk of supply disruption. Mexico. Silver production is entering a period of elevated uncertainty in the second quarter of 2026. The only question is whether market participants positioned before disruptions materialize or scramble reactively after the fact, when premiums have already exploded and physical metal has become allocated to those who secured supply earlier. This is the story of Mexico's silver revolt, the convergence that sophisticated money is watching carefully, the challenge that's developing in real time, and the potential wealth transfer event that will separate those who understand physical supply realities from those who only monitor price charts. The mountains of Zacatecas, Sonora, Chihuahua, and Durango are where a quarter of the world's silver comes from, and those mountains are navigating the most challenging operating environment in decades. The information is available. The patterns are observable. The decision is yours.